Well, our next guest said back in August that he thought rates would quickly move to 4.5, maybe beyond. Let's bring in Damped Spring Advisors CEO Andy Constan. Andy, great to have you back. That was a great call by you, and that was on the news that the Treasury was going to, have a much bigger than expected issuance. So the issuance hasn't actually happened. A lot of the move has happened, and so how do you expect this to play out at this point?
Right. Thanks for having me back, Melissa. Yeah, since the government announced a significant increase in the amount of long-term Treasury bonds they plan on issuing, shifting from bills to bonds, the S&P's down 7%, Nasdaq's down 7.5%, Russell's down 11%. The two-year note, which I agree with Guy, is basically fixed, but is up 26 basis points. But really the big action has been in the 10-year and the 30-year, which are up 65 basis points and 71 basis points. And as you said, the supply hasn't really come to market yet, but the supply announcement clearly mattered. So what we're having is a bit of front running of that, where markets price in this additional supply. And so I think about 75 to possibly 100% of that pricing in for the supply has happened in the bond market. And it's possible that when the supply actually does come this quarter, that you could push yields a little bit higher. But I'm thinking that most of this run has occurred, and you've got 10, maybe 15 basis points more of higher yields in the near future.
So you've covered a lot of your shorts in this position, Andy, and that's simply because the risk reward is not there anymore. I mean, you're saying that yields will probably go higher, but at this point, it's not worth shorting bonds for that move. Right,
exactly. I mean, you can choose to be long, short, or flat if you're a speculative investor or a hedge fund investor. And the choice right now is to have no position because, I do see a possible, I do think a likely 9 to 15 basis point increase in yields, but it's come a long, long way. And so a bounce on weak data or any sort of a weakness even in equities would, support bonds briefly, though I think the supply means that going long bonds speculatively doesn't make sense because you're just going to run into that wall of supply.
And it was great to have you on when you originally did. It's great to follow up now. Well done. So there's what I think could potentially happen. If yields were to go lower, markedly lower from here, it's probably because something broke, and broke meaning the equity market, and you'd have this sort of perceived flight to quality in the form of the bond market. I don't think that's particularly healthy, but that's a scenario. Does that make sense to you?
Sure, but I think that is how things have played out year over year for 40 years. When things get bad, bonds rally, but it usually happens after stocks fall. And I think the recent rally in bond yields, the rise in bond yields, the sell-off in bond, has not been felt yet by the equity multiple. So I think the next step before we get to the step you're talking about is for equity multiples to contract a little bit. My sense is the same sort of move in equities that we have had. When you add on the move to bonds, equities need to catch up a little bit to the downside. My guess is around 5%.